Good morning. I'm Professor Lew Spellman of the University of Texas McCombs School of Business. We're delighted to have the opportunity to hear Adam Fisher today, who is the CEO and Chief Investment Officer of Commonwealth Opportunity Capital, as a guest speaker in my classes today in financial markets. Adam, we appreciate your taking the time to be with us today.
Thank you for having me.
The main question that we'd like to deal with is the story of how we got here, both in the economy and financial markets. We had an asset bubble probably building up from 2003 to 2007, which started to crumble, and about a year ago this month, the financial markets crumbled and brought down financial institutions with it. This year, in 2009, we've had a dramatic reversal, both of the markets, but not of the economy. Can you possibly reconcile that divergence?
We sit in an interesting juncture in time. As you point out, we had an asset bubble, which aren't unusual, quite frankly. They occur, whether they occur in one country, they occur in multiple countries around the world. They are more typical than people think. And usually the response to those asset bubbles are similar to the response you're seeing right now in the United States. I would say the unique nature of this bubble was its magnitude. You had participation by not just the United States, but you had participation in Europe, you had participation in Asia, and the imbalances that built up globally were unique. I mean, by way of example, if you were to compare the East Asian financial crisis in 1998 to this crisis, which actually is very similar in many ways, the fallout from that crisis and the distress that it caused both on the real economy and on the financial systems more largely was much less than this particular bubble. But the responses are similar. The responses are to provide as much liquidity as possibly can be provided. And in some cases, to try to clean out the financial system through massive recapitalizations of the banking system and potentially, depending on the country's ability to borrow, fiscal stimulus and the like. I think an interesting parallel, again, to the 1998 financial crisis is the IMF, which was prescribing means to help, whether it's Thailand or Indonesia or Korea. Their prescription was provide liquidity to the financial system, recapitalize the banks, but have significant fiscal austerity. All those countries experienced massive contraction and growth in a very short period of time. And they experienced a big devaluation in their currencies. That process allowed them to come out of their economic problems very quickly. Japan, which is sort of another country that experienced an asset bubble, was not so lucky. The size of the bubble, like the bubble that we have here in the United States, was incredibly large. It had infected basically every element of assets within Japan, whether it was real estate, stocks, bonds, everything. And their ability to get out of their problems was, and actually still is, very problematic. So in the United States, we're following, in my opinion, a very sort of Japanese-esque approach to the bubble that we've had, where certainly we've provided ample liquidity. We've gone to what we call ZIRP, or zero interest rate policy, quantitative easing, massive reduction in interest rates by the central bank. We've passed a fiscal stimulus bill of upwards of 4 to 5% of GDP. And like Japan, they did the same things. They, BOJ had, a zero interest rate policy for quite some time. They were building bridges to nowhere over there for decades or years. Decades isn't fair. And all the while, they didn't experience the, in effect, rebound in the real economy. And this is what you're alluding to and the problems that you're referring to. And I believe that the distinction, quite frankly, between the distinction, in my mind, between, say, the policies that were prescribed in 1998 that really did pull these East Asian countries out of their problems, and the policies that, for one, are being prescribed today in the United States and were being prescribed in Japan, are very similar, the distinctions. And I think the major distinction is a political unwillingness to allow for true price discovery. And the reason for that is quite obvious. I mean, you know, starting in September of '08 and all the way through March of '09, it appeared that the government was going to force the banks to mark their assets properly, mark their loans properly, and whatever the consequences of that were, they were. The banks were bankrupt and they were insolvent, then they would need to be recapitalized. How they were going to achieve that, you know, was open for debate. But starting after Geithner gave a speech February 10th and leading up to March 3rd in his final speech, and then in April they changed the accounting rules where they basically allowed the banks to pretend and extend, you know, their entire books. I believe they decided against that approach. In effect, sort of we could call it the intellectually honest approach. And I think it very much parallels what Japan decided to do.
So the question I have then is, are monetary and fiscal policy, are they part of the solution or are they part of the problem?
Well, I don't think there's one right answer to that. I think that the answer is that if done properly, monetary policy and fiscal policy can be part of the solution. If done improperly, they actually probably create more problems than they actually solve. And unfortunately, I think we're in a position now where the way in which they've chosen to use those tools probably will cause, or could, I think they've increased the risk of causing more problems than they've solved. And I think that's unfortunate because I think I don't think there's anything inherently wrong with fiscal policy or monetary policy. I think just like every other tool, if used improperly, you're not going to get a positive result. And I think they've increased the risk of a negative result because of the way in which they're deploying those tools.
Right.